What's up, everyone? Welcome to Let's Talk Markets with Dave Lauer. I am your co-host, Pink, and we are continuing our monthly markets discussion. Dennis was unable to join us today, but we have Erik Smolinski with us as the in the spotlight position here in our fancy new layout. Erik, thanks for joining us.
Blast to be here. Great to chat with you guys. I'm looking forward to see how I can be a pessimist this month. Apparently, I got to keep my act on. So we'll see.
Carry that torch.
We'll see how we fare.
Yes.
Yeah, we'll see.
Now, just having Erik, we know the complexion of this episode is going to be very different than usual. Usually it's balanced. I think this one's will be negative. And then we've got our monthly macro markets, where the general sentiment, Erik, so you're aware, is no recession. The country's killing it.
It's pillow soft.
Yeah. The Fed just nailed that soft landing.
Yeah.
So.
I love that idea. Funny enough, if we take a look at
let's get right into it.
If we take a look at the bond movement right now, the target rate probabilities for the 20 March meeting, as of literally 1 day ago, it was a 77% chance of 500 to 5.25 target rate, and that is contracted now to 65%. So pretty meaningful change there. The part that I like is the probability of target rate being 5.25 to 5.5 went from 19% to 33%. So it's almost doubled for there to be no change as compared to there being a cut, at least the first cut happening in March.
I think there's going to be a cut at this point, right? Because it seemed like inflation was coming down, labor market was staying strong. They said they were done with raises, so a cut early on seemed plausible. Maybe like that high of a percentage, questionable. But now we've seen another inflation print higher, so that's going to be a concern for the Fed. The labor market continues to be strong at a top level. Internals, not thrilling, but nice. But now the market still pricing in a cut more likely than not in March seems absurd to me. And I will say this: I will give. I think it was Claudia on the previous macro markets episode said the Fed will always do a meeting later than you think they will. But this seems like March seems crazy to me. There's not going to be a rate cut. Market dude, right now, no rate cut in March, according to the Monthly Markets podcast.
Well, according to half the Monthly Markets podcast. Well, I guess a third, because really, Dennis can't defend himself.
No,
but
that's right.
Yeah, I mean, at least in terms of like the Fed's actions, I would have to agree with you. I find myself analyzing a really interesting juxtaposition behind like what the Fed says and what the bond market says, and who actually is leading this dance. I actually don't know sometimes, because the Fed always has the capacity to say, no, we're doing X, Y, or Z. But the bond market also, a lot of resources in the bond market, they have a voice. So to your point, the bond market disagrees with you still. It says 67% chance of an ease as of right now. So we'll see if that contracts. I think after the 31 Jan meeting will be pretty informative, at least once we get the meeting minutes from that. I always like
fair. The bond market is a bunch of guys that couldn't cut it in equities. All right. So like, what do they really know? All right, come on.
Yeah.
I'm gonna get some hate mail on that.
If the bond guys are gonna try to hit you up, though, they're gonna probably mail you a letter. You're not even gonna get it via email. So you're okay.
Here, buddy, I'm gonna click this coupon and mail it back to you.
But when I saw that change in probabilities, I did find that really, really interesting, because as I look across the subsequent changes day over day, month over month, week over week, like that is a meaningful 1 day change. So to your point, I do think it wouldn't be insane to see the probability of no change continue to price more into bonds. And as I look at the way that the Fed has been messaging about this, I feel like they've been pretty steady. They've been saying, we're waiting until we feel inflation essentially is strangleheld. And there's still these little spikes popping up here and there, which is interesting because we didn't think it was going to be so persistent, but
So Eric and I have we've had this, since inflation started, and I was team transitory, and Eric was not, and what we saw is team transitory was pretty spot on. Just it was a lot longer, right? We all thought it would be about a year of inflation. It ended up being about 2 years. It has come down to much more reasonable levels, but let's face it, like 4.7% inflation is still high. It still hurts people. There's no doubt about that. And that means it's still there, right? Like, we are not down to a 3 handle. We're not down to a 2 handle, which is what the Fed wants. And it's hard to see them cutting absent like economic catastrophe, with inflation staying persistent, even at this moderate level. Like, yeah, we're not at 9%. That's, thank goodness, but it's not. I don't think that's making a lot of people feel better.
Yeah, and on that same vein, thinking about how the market is holding up and how the economy is holding up, it's what I'm trying to understand is how we're valuing different inputs, because some things look good in terms of fighting inflation, some things don't look in terms of fighting inflation. So, and I think the most commonly heard discussion I have, at least against the Fed being able to nail this soft landing, whether it happens or not, I never pretend like I know what I'm talking about, because I'm an observer. You know what I mean? Like, there are teams that have spent their lives on this stuff. It's fun to speculate. I'm fascinated by it. I don't pretend to know what I'm talking about. But when I look at the broader state of the economy, I don't really see where what is the defining function behind the Fed now choosing to cut rates, like you were talking about, whether it's inflation is all the way down to 2% from where it was, which most, I think, would argue, if you wait until inflation is at 2%, you've over tightened and overheld and then some, because there are significant leads and lags in the economic system. It's big.
Yep.
So to me, I agree, and I see your point, but then I also think of it as, well, then when is right? What are your thoughts?
Honestly, this would be if they cut soon, and I think they will. I think they will cut, let's say, sometime this summer, unless inflation hits back up.
Right now, 1 May, there's a 98% probability of an ease being priced in.
Yeah.
I think Claudia called that too. I was about to say, I'm pretty sure Claudia said May.
Yeah, she thought May, and she thought March was crazy. Again, it's definitely going to be a meeting after you think it will be. So I don't know about that. Who knows where the economy is going to be. But if they cut in May or June, or like sometime in the next, let's call it 7 months, without some kind of like economic catastrophe, that is somewhat remarkable of a move. Like, that's a novel move for the Fed to try and get ahead of the turn, to try, exactly as you're talking about, Eric, to try and like continue to think forward, to say, look, there's going to be a lag to what I do, so I better start it before I ordinarily would have. And I think we're going to see that. I think that's how they think they nailed the soft landing. So, on the one hand, there's this idea that it's going to be later than you think. And then on the other hand, there's this idea it's going to be earlier than the Fed ordinarily would, in order to try to not overshoot.
Here's my next question for you then. Based on, I don't know if you saw Fed Waller's conversation today, but they're looking at 3 25-point cuts, basis point cuts this year. Yeah. So if we start as late as you're thinking, then is it rapid cuts from there? And if so, we know that will have impacts. So how do you think that plays out in that scenario if we wait that long?
No, I mean, I think it's an every other meeting kind of thing.
Got it.
I think they're going to try really hard to not do anything as rapidly as what they just did. What they just did was crazy.
Right.
And if they do manage to pull it out, which the jury is still out, we will see. I think by by the election, we're going to know one way or the other, dear Lord, by November. And if they do manage to pull this out, which is to say that things don't worsen materially from where they're at today. And we were just talking earlier before we started about the Empire State Manufacturing Index, which came out today at an extremely negative number. So there is a question as to, have we just been waiting on lagged effects, and that dramatic interest rate hiking is going to start to make its way through now, where we're going to see significant demand destruction, which is what the Empire State Manufacturing Index would suggest. We see crude trading at 72. It's relatively low versus where it's been for the last couple of years, which signals further demand, weakening of demand. If the demand side weakens, which there are indicators that it is, I think the Fed does get more aggressive in its cutting schedule. But I don't think they're going to go as fast and at the same magnitude as they raised rates, because that was unprecedented. But I think you had to be unprecedented coming out of ZIRP. There was no way around that, right?
Yep. Yeah, and I also fully agree. I think they pulled the emergency stop lever when they did when raising rates, but I think they would be wiser than to try and repeat that kind of approach on the easing side of things. My overall sentiment right now would be that if we did go into a period that they needed to slowly lower rates, and that was at our own pain, I still think they would probably pick that route, because otherwise we start this pendulum with increasing force on each side. And then I think you kind of throw things off balance pretty quick. To your same point about crude oil, the dollar is up pretty big today compared to at least where it was trailing down. It was almost down to 100 the beginning of the year, end of last year, the dollar index, and now it's up like 103. So dollar is starting to rebound as well, which I don't think they want to see that go too high.
No.
So
but there's demand. There's demand for dollars. There's demand for treasuries, right? The rates have been dropping. There's somewhat of a flight to quality, I think, right now. So I think this is like one of the most interesting economic times to possibly live through, and we're watching this experiment like unfold before us.
It feels so like we're so numb to the fact that we're living through so many unprecedented things. And I as you're talking, I keep wondering how, of course, election cycles, historically, they don't typically really affect markets, that much. They're overall positive, but we're kind of entering into an unprecedented election year. And so I just can't help but wonder how all of this is going to play into that, because there's an overall air of uncertainty among everyone lately. So it's just it's going to be interesting to see how that plays out.
Speaking of flight to quality, how about the quality in these new Bitcoin ETFs? What's your take?
I knew that was going to be a sell the news, buy the rumor, and man, is it playing out. Like, there's just not a lot of demand for Bitcoin ETFs. I think a lot of companies, a lot of issuers are right now really frustrated and upset. And I think a lot of Bitcoin maxis are frustrated and upset. I don't know. I'm not shocked. And then, I was reading a really interesting thread on this where they were pointing out, first of all, there's less than $1 billion of actual demand on day one of the Bitcoin ETFs. And in fact, like the main ETF, the Grayscale, which was the one that, the court case that led to all of this, and they converted from a closed trust. as soon as the price got, because it was trading at a huge, like a 25% discount to Bitcoin, as soon as it got to parity, there was a flood out of it, which countered all of this demand. So in aggregate, there just wasn't a lot of demand for Bitcoin. I don't know. I don't know. Like, I was trying to find. I couldn't find this. I looked all over. I couldn't find. But I had remembered reading a piece, and I probably could have put this together. I just didn't have the time. But when Bitcoin futures were rolled out on the CME, there was the same dynamic of a price run up going into it, and then as soon as they rolled out, it collapsed, right? The price collapsed. And that's like a standard thing that happens when something gets securitized and commoditized, because suddenly, people, it's a lot easier to buy and hold Bitcoin without it being securitized than it was to express negative sentiment towards it. And now it's really easy to express negative sentiment towards Bitcoin. And so, you see a lot more of that. So I don't know, man. A lot of people were talking about billions and billions of inflows and $100,000 Bitcoin by the end of the year and 250 by next year. Not seeing it right now.
I mean, I feel like that's what you got to do, though. You got to put like the Bitcoin eyes on your Twitter page, and then you just say big numbers. I think that's the secret. And you just
where's your S2F model? You see the rainbow chart.
Don't forget the Doritos of doom, Eric.
Yeah, I mean, really, I feel like that's the ensemble that we paint. It's interesting you say that, though, because when I look at Bitcoin futures, they're cash settled. So if I wanted to trade Bitcoin, to your point, I would trade Bitcoin itself, unless I want to fade Bitcoin, or what I like to do is trade volatility. That's the only utility to me of a Bitcoin ETF, is the ability for me to trade options on them. Yeah, and right. They are relatively liquid. They're not as bad as I thought, but the volatility in them is very interesting.
But the ETF is cash settled too.
Yes, that's right. Absolutely correct.
The SEC did not allow for in-kind redemptions, so everything is cash settled right now.
So something like BitO, which is the Pro Shares, they use non-equity index futures. They also have swaps built to create the exposure that they want. So it's kind of like a VXX style product. Where they're using derivatives to create the desired exposure. But to your point, they're not holding any Bitcoin. There's nothing there. It's like my favorite part of traditional finance. The more you look at this stuff, it's all just fairy dust. It's just smoke and mirrors, dude. Like, if somebody was asking me this past weekend, like, what do I do? And I'm like, the hell of a question, because mostly what I do is click on an online interface from my house and somehow money moves around. I don't really know. But when I look at trading volatility strategies on stuff like BitO or other Bitcoin ETFs, to me, that's the primary utility, at least as far as I see. But when I look at, if I were a consumer looking to gain easy, quote unquote, exposure to Bitcoin, none of them address what I would be looking for personally.
Yeah, because the chart, when you look at these ETF charts, right, it's, I mean, obviously it's going to look similar to the Bitcoin chart, which is up and then down. And it's like,
yeah, and especially if you zoom out, and especially on something like BitO, at least over the last 3 months, you're like, wow, this is moving pretty well. This looks good. And then if you zoom out to inception, you're like, wait a minute, it was at 44.30 and we're still half there. Yeah. Not good.
Yeah.
So what's just a quick in layman's terms, Eric, in your sunshine and rainbows way, can you explain what this means for Bitcoin? What these new ETFs and everything mean?
It's a good question. And it's one that actually Dave and I were kind of just conjecturing, trying to figure out the utility of it. Because if you think about ETFs like this, a lot of times, like, let's use SPY for an example. If you wanted to buy the S&P 500 index and you wanted to collate that yourself, you would have to go buy all of the individual products within the S&P 500, all 500 plus of them. It's time consuming, capital intensive, so on and so forth. So SPY is created. How does SPY represent the S&P 500. They buy all of those individual companies for you, big buckets of money so that they can do that. And you gain your exposure that way. They rebalance it for you. That's part of the expense that you pay there. So when you look at a product like SPY, it's holding the actual things you want to get exposure to. If we look at something like BitO, it's not holding any Bitcoin whatsoever. It's holding Bitcoin futures, which are a cash settled product. So it's essentially tracking via an indexing method where it's just using math to try and track the price of Bitcoin and to behave close to Bitcoin, but in no way is it Bitcoin at all. So they're telling you, hey, this is Bitcoin, here's an elephant, but it's a giraffe. It's completely different.
Yeah, it's financialization, right? Like they're financializing Bitcoin even further, right? So if Bitcoin is supposed to have two, value propositions. One is that it's a peer-to-peer exchange mechanism. I can send money directly to you. There's no intermediary, right? I can use it. And then the two is a store of value. And so, yeah, the ETF can act in a way as a reflection of its value. And so it sort of is a couple levels removed, but still allows you to express the store of value side of it. But the only reason it supposedly has value is because it's useful. And this does nothing for that, right? It only has rarity in this context rather than utility. And it's weird. I think that it is almost sort of like against the ethos of Bitcoin. But if you're a Bitcoin maximalist, I mean, I haven't seen anyone who isn't thrilled that this happened. But there are also people who want you to use it and acquire it directly. But that's hard for a lot of people.
When I hear hard, it's but how hard, right? Like you could buy you could buy Bitcoin through PayPal and you can get direct exposure. And then if you want to hold it on your own, you could do that. Yeah. So I guess maybe if you want to tokenize it and hold it yourself, that is a little more complicated, especially if you have, all of your life's wealth in a random seed passphrase that you can't remember. Yeah, that could be a little bit of a problem. But other than that, I feel like Bitcoin has become accessible enough. But overall, to your point, I still completely agree. When you look at what these ETFs are supposedly doing so far, if I was a Bitcoin maximalist, I would be stoked to see that they're gaining recognition. They're starting to be integrated into broad financial systems. But I also, in the same vein, would not put my money in that.
No, I know. That's the fun, right? Is that the irony of it?
Right.
So a while back, I explained ETFs in very Eli 5 layman's terms as in Beanie Baby terms, and the ETF was a basket of Beanie Babies. Like each Beanie Baby was a different stock, and I had the little stick figure drawings to go with it. It was an early Reddit DD that I did, and so that's how I explained it. So what you're saying is there's no Beanie Babies in the basket; it's just a basket.
That's great. That's exactly it. You look in the basket, there are no Beanie Babies. There are little pieces of paper that says, this is this Beanie Baby. This is this Beanie Baby.
It's like a Dumb and Dumber. It's like IOU.
Yes. Yep. That's exactly it. Because especially when you look at the process of holding futures to replicate a product, it's expensive. It's not cheap to use future-based products to replicate exposure to something because you have to have different exposures because all futures expire. So this goes down a whole other rabbit hole, but just suffice it to say, if you are trading,
and this is important because a lot of people don't realize sometimes that they're using exchange traded products that use futures that have that have this roll cost to them that it's called, especially in leveraged products. And that's why this stuff is not to be held as an investment. These are generally trading products. But yeah, go ahead, Eric, explain why there is a cost to this and why it's not it's not the same thing as simply holding the underlying.
Yeah. So if we look at BitO, just to continue using that example, right now, they're weighted at 54.3% Feb 24 futures, 44.4% January 24 futures. So January is coming up, a couple weeks left. That's 44% of the portfolio. So what's going to happen is I haven't looked at the prospectus, so I don't want to speak too far out of turn here, but typically what will happen is you will pare down your front month position and buy more of a back month position. Sometimes this can be done essentially net fees, even rarely the case. Normally, there's a roll yield, which is a cost to gain exposure further out in time. Because exactly as you would expect, things that are further out in time tend to be more valuable than things that have only a couple days left to go. So as they look to maintain their exposure, they're continuing to move these products. So even apart from the roll yield, the differential between what they're selling at and what they're buying, there's also friction. They're interacting with the marketplace. There's transactions occurring. There's commissions that, guess what? They're not paying it for you. You get handed that. They're like, here, this is part of our expense. I'm not paying that. Also, pay me for doing that for you.
Yeah.
So it starts to become expensive to hold stuff like that long term. This is why something like the S&P 500 SPY has such a cheap expense ratio, because it's just a mathematical derivation about, I'm supposed to have 10% SPY or 10% Apple, 15% Microsoft, whatever it is. And it just rebalances it automatically. There's not like a human being there doing anything complex. They don't have to move those things too frequently, because the balance of those products within the S&P 500 doesn't move that much. So overall, it's a much cheaper endeavor if you're looking at something like SPY that's holding the actual products. You're looking at something that's futures based. You have that roll yield, you have commissions, you have the dude that's doing the work that wants to get paid. All of that serves as friction on the product.
Yeah, so I worked at a high frequency firm that was a huge player in the futures market, and these kinds of roll products were just gold, right? Like it was like money. So I can tell you, like, the high frequency intermediaries love this shit. And I can tell you that, like, what Erik is saying is really important from another perspective, which is like, how does demand in the equities market for ETFs transmit itself to the underlying instrument? And when you have it at this level of separation, it's not like you would think. Whereas with SPY, which is the perfect example, you have to understand how it works, right? So when you go to buy stock, you buy from a market maker, so-called market maker. It's a, but generally, let's say you're buying from what's called an authorized participant. Okay, so you're buying SPY, right? You're buying this ETF. I, as the authorized participant, am selling SPY to you. So I go short SPY, right? And to hedge it, I'm buying the 500 stocks on this side, right? So I'm long the basket, I'm short SPY. At the end of the day, I go to the company that issues the ETF and I say, here is a basket of those 500 stocks. And that is an exact what's called creation unit. This adds up to 50,000 shares of SPY. And that company says, great, here's your 50,000 shares. That 50,000 shares wipes out my short position. I make the spread. And now that company, the issuer, is holding that basket of stocks, right? So what you did when you bought SPY was you created demand for the underlying stocks directly, right? Or at least one level through the market maker. Whereas we don't have that kind of thing in some of these exchange traded products.
So just a deep cut. Dave Lauer just completely validated the Beanie Baby DD from like 3 years ago. And I'm weeping with joy inside. And I'm definitely going to share that here and insert here that the one that I mentioned earlier with the basket. That's exactly what how I relate it with another fan favorite stock. So that's an interesting point. But I'm hearing all this, and it's like, you would think that introducing these new ways to trade on Bitcoin, that would add to the legitimacy of Bitcoin in the marketplace. But then everything I'm hearing is detracting from the legitimacy. So like, where does that land?
Well, I feel like it's a mixed bag, right? And it depends on what we mean by legitimacy versus utility purpose, because the fact that it is turning into a broad financial product, that there is legitimacy that goes with that, right? Like, all of these random coins aren't out here doing the same thing. So it tells you something. It tells you that there is something here that people can at least assign a value to.
And Gensler was very clear in his statement. And he was like, first of all, there's a ton of risk here. And second of all, despite this being approved for Bitcoin, that means nothing for any other cryptocurrency. Let me be clear.
Yeah, which
an ETF anytime soon.
So to that vein, I think that it does add to legitimacy, but it goes back to kind of what we were talking about is the actual utility and the purpose of it, which is to be seen, right? Dave probably can forecast that even better than I can, just from, like I said, from like a simple trading perspective. I would trade volatility in it. And all of that means is I don't care which way it goes. I really don't care. What I want there to be is a bunch of people transacting at a bunch of different prices, creating a lot of friction that then vultures like me can try to find a couple bucks to walk away with. That's about it.
All right, so let's switch gears a little to volatility. What are you seeing in markets to start the year? How has 2024 started from a volatility perspective?
So we had, speaking of what Pink was talking about before, like the ability to see different volatility regimes, over the last 6 months even, we've seen a pretty significant change. We would call it a volatility regime. And all of this means, in kind of overview, volatility has certain properties, kind of like gravity, where one of those properties is it tends to cluster. What that means is if you want to have an assessment of what volatility is going to be like tomorrow, look at what it was today. And it typically will do that until it changes. And then it goes into what's called a transitory phase, where it's moving either from a previous cluster to a lower cluster or moving from a previous cluster to a higher cluster. But all of that is to say, last year, you had the opportunity to look at a very different volatility picture than what we're seeing in kind of the last 2 months. Whereas it peaked back in October up at 23, which isn't that high, but it traded in that range for a couple months. And then now, essentially from the end of November, it's been hovering around like 12, 13, much lower than where it was previously. So you saw a transition. Now, the interesting part about volatility as I see it now, it's been asleep. It's been kind of oscillating slightly within that range. But yesterday, I was looking at the futures open and the E-minis, S&P 500 futures, they opened down very slightly. It was like, they're like negative 0.3%. But the VIX futures were up like 6%. It's not a one-to-one relationship. So I don't want to make that sound like crazier than it is, but that is still dislocated compared to the move that we saw in the S&P 500. And we're seeing it continue through today. Right now, as I look at the E-minis, they're down 0.5% and change. And if you look at VIX futures, they're up 5.5%. That is a dislocation between the two products. So when you're looking at volatility, you don't really know exactly what that means, but it tells you something's going on. And that typically, if you're a trader at least, that's enough. You don't really need to know the answer. You just need to have some ideas on where to look for opportunities to then position yourself with those opportunities. Now, it's still too early. It's one-day move, nothing to read into here yet, but this is a change compared to the norm as we've seen it.
And so where do you think, what are the opportunities you're looking at, let's say, if this is something of a persistent change, if we're going into an environment in the short term where markets are, softer than they've been, and volatility is a bit higher, how do you position yourself?
That is the ideal scenario for most options traders. Is volatility is what we want to see. I don't really care what way things go, but if there's not volatility, there's not life. There's nothing I can do. So in this case, when I start to see volatility moving, again, I don't think it's too early to tell, but a jump with it moving from 1265 to 14 in a day is meaningful enough to me to want to keep an eyeball on it. Because to your point, Dave, if we start to see a bit of follow through in volatility, that opens up a whole suite of strategies that apply to that kind of condition. You can even work different kinds of pair trades where you fade the indices, go long volatility, and that overall will reduce your risk in and of itself. It has a built-in hedge, decreases your profitability slightly, but again, all dependent on the trader. The main thing that I'm looking at now, though, is do we get a continuation of volatility? Does it start to cluster above 14 and maybe gain some foothold? Based on what I'm seeing in the news, again, it's hard to tell with the news, right? It's a lagging indicator, but I'm not seeing sunshine and rainbows everywhere. We were talking about, and that typically bodes well for volatility. Now, the other thing that I am looking at specifically with volatility is earnings. We are now in an earnings season. We're seeing banks reporting earnings. They just started last Friday. And one of the things I try to tell most traders to do is pull up the earnings release from a couple of the banks. Ideally, some of the larger banks like Goldman Sachs, JP Morgan, that are kind of working mostly on the institutional side, and then some of the smaller banks that are working kind of more broad suite with a lot of different consumers. And you can learn a lot about broad market trends by looking at what the banks are talking about. For example, when you look at Wells Fargo, you'll see credit loan charge-offs going up. That tells me, for consumers to be specific, that tells me consumers are not doing super great. They're struggling to pay their credit, and the credit card companies are saying, this is part of our write-off. I'm not going to keep going after them. It's not worth it. And they're moving on. The other thing we're seeing, home loan originations, still awful. And auto loan originations, this one surprised me a little bit, but that's cratered even more still. And all of that coupled with consumer credit starting to spike up, it's just an interesting perspective. But
yeah, I'll tell you, the retail earnings are where I have my eye this, for last quarter. I want to know, what were sales like? What was the holiday season like? How strong was it? I think that's a huge indicator that's either going to line up with the kind of things you're talking about, or continue to surprise us at the strength of the consumer. I don't think we're going to find something in the middle. I think this earnings season is going to be one of the most instructive that we've had in a long time, and it's going to hopefully reduce some of the uncertainty around what's going on underneath the covers with this economy.
Yeah, and to your point, at least early looks, I wouldn't call the consumer strong. That's at least not what I'm seeing. It doesn't look like they're, falling out of bed and not able to do anything. But I am seeing people trying to use more credit for general expenses. That credit's not going to big purchases like houses, autos. And yeah, exactly to your point. This is one of those really informative seasons, which takes us back to the original point on volatility. Because of that, because you can tell this is a highly anticipated earnings season, there's a lot of volatility. So very tradable events for us.
All right. Well, I think we covered everything that we wanted to. Anything else? Anything else you got your eye on right now, Erik?
Did you guys want to talk about the canal real quick? I was actually curious what you guys were thinking about it.
Sure. Yeah. I think what's happening in the Red Sea right now is a huge risk, a huge geopolitical risk. The fact that nearly all shipping is being sent around the Cape means a few things, right? So it's going to mean further supply chain uncertainty, which is just the last thing anyone needs right now. It's going to mean that the reduction in inflation is likely, it's a headwind, let's call it. Look, I don't know if it's enough to halt the reduction in inflation, the disinflation that's been taking place, but it's possible, right? So shipping costs are going to increase. Time to receive goods is increasing. All of this has, these effects, these downstream effects that take some time to unfold, but this is a really big deal. And it's a huge question is this temporary or not? And the fact that there was another ship attack after I think the US and UK sent a few missiles over, which, tends not to do much and didn't do much at this time.
And really said that they were targeting U.S. ships. I mean,
it's crazy.
There are no qualms about it.
This is what the Houthis are doing is surprising to me. They're launching missiles into Israel. They're attacking American and international shipping. That suggests that they've got, some power behind them, which we know, like they're an Iranian proxy. But it really, if this leads to some kind of larger conflagration in the Middle East, and what is happening in the Middle East is already horrific enough, a full-blown Middle Eastern war, all bets are off the table, right? We're economically market, who knows? We have no clue what that could mean. Then you see a crazy spike in crude, you see huge and lasting shipping disruptions. That means widespread inflation again, which will be absolutely destructive.
I'll buy Raytheon and solar panels. That's where I'm at.
Right. I
And
mean,
beans.
so I am. I mean, I'm nervous. I will not lie. Watching this unfold and fearing what it could become. I really hope this is something that fizzles, and we look back on it and we say, "Wow, that was an interesting couple of weeks, and we can learn from it." And now we've moved on. If this becomes, something much deeper than that, that's a global economic disaster waiting to happen.
Yeah,
So-
I view it similarly to you. I look at the propensity for this to spiral, and at least based on what I see right now, I don't see a strong case for it, but that's never off the table.
Yeah.
And part of that is because I think that the U.S. military also has a pretty defined understanding of the U.S. perspective on a large scale war in the Middle East.
Yeah.
Right. Not really great memories there.
Right.
So I don't think they would be in any sort of significant rush. And also, the Houthis, they're supplied well, but we have stuff in our tool bag for stuff
Yeah,
like
I mean,
that.
right. Like the U.S. hasn't really done it. Like we were like, oh, here are a few cruise missiles. Like, just stop. Like this is us telling you, just stop. And they didn't. And so what happens when the U.S. military really brings a little force to bear? Can they, and are they really looking to withstand that kind of thing? Again, that I think that's going to happen. And then the question is, what's the outcome? Is the outcome they're like, fine, this is not what we're looking for? Or is the outcome, okay, suddenly Iran enters, a militarized conflict with either Israel or the US?
It would be, I mean, that would be an interesting turn of events. I think if I were to wager, what would I expect to see here is just a stronger military presence in the movement of ships. And then you're going to probably see dudes getting smoked when they're trying to shoot at U.S. ships. But I don't think that the U.S. is going to attempt to create a bigger issue than it needs to be, because we're still obviously dealing with that whole Russia, Ukraine. I know a lot of people probably forgot about that. Still a thing. And we obviously have the whole issue with Israel kicking off. So there's a lot going on in the world right now, not to turn this into a geopolitical conversation, but to your point, all of these things, that's my favorite part about markets. These are all fed back into the market.
Absolutely.
And that's the most beautiful.
You need to stay on top of this stuff if you're going to be in markets.
What I tell people is the coolest part about the markets is that it's a way to consume a lot of information without getting too muddled down in the left, right, middle, up, down perspectives.
Right.
Like the markets care about money. Where's the 100%. Money?
100%.
And you can focus on that, and it's pretty easy. But yeah, I'm glad you brought it up. And I'm also really glad you mentioned the part about Iranians' involvement, because I think a lot of people might not understand the potential implications of that, which is a really important call out. So yeah, I figured you had a good perspective on it and wanted to hear it. So thank you for sharing.
Yeah. And I mean, I think to your point, like the US is really good at shooting down missiles. That's like something we've really developed a core competency in. And if we're able to shield that lane enough, and avoid, blowing it out into some bigger conflict, I think that's a good outcome, but it does leave some risk out there. And it's hard to know, like, we know insurance rates are going up like crazy right now. It's hard to know if shipping will resume given a risk like that. So I don't know. Well, I think in a month on our next episode, this will be something. Let's pick it up next month and we'll see where we're at.
That actually be really cool to see how it plays out over time.
Fighter jets flying along the canals, and somehow that cost is still going to be passed on along to us, even though it's budgeted to the military. So that'll be fun.
Yeah. All right. Well, thanks, Erik, for joining us as usual. I hope you enjoyed our monthly episode on markets on Let's Talk Markets. Next week, we'll be talking with Chris Giancarlo, former chair of the CFTC, about CBDCs. And I think that's going to be a fascinating conversation.
So these are FLAs. These are 4-letter acronyms.
That's right.
We've covered TLAs. Now we're moving on to FLAs.
I know all the TLAs, but man, that's a whole other world, these FLAs. Yeah.
Yeah. We've graduated.
Yeah, that's right. That's right. So as always, subscribe to our YouTube feed or whatever podcast network you're listening to us on. Leave us a rating, leave us some comments. We're always there. We love reading them. We love hearing what you think and what you want us to cover. And we're here to respond to you, our subscribers, our listeners. So thanks for taking the time. And we hope you found it informative and enjoyed it.
Yep. And you can always meet us where we're at Irvin.finance. We're always there in the communities talking about the podcast and everything that we cover here, plus more. So be sure you join us there and hit the subscribe button, and we'll see you next time. Thanks for joining us.
Thanks, everyone.